Hey there, and welcome to this weekend's premium newsletter. So it's been another important week for the history of cryptocurrencies. We began this week discussing the recent pumps with Monero and Ripple. Monero just had a hard fork and, as we said, was likely a scam and so would not be worth investing into Monero just to acquire. Ripple was pumping because Coinbase listing rumors due to the Ripple CEO and Coinbase president appearing on a CNBC interview together. Coinbase was quick to dismiss any rumors of any new listings in the near future, though we believe Ripple is one of the top candidates. It seems a big reason they're shying away from adding any additional new currencies is that they're now at the center of several lawsuits regarding their business practices. In particular, one suit alleges that they engaged in insider trading surrounding their listing of Bitcoin Cash in December. As such, they're likely looking to clear that up before they move forward with any new listings. In addition, they're being targeted with lawsuits for withholding customer funds and for not properly enabling two-factor authentication security measures to prevent theft. In response, they're increasing their legal team, and despite this, they came out to announce that they had a Coinbase index fund in the CNBC interview, which is an important step to legitimizing crypto and attracting mainstream plus institutional investment. That being said, we believe the future is opaque for Coinbase. They're clearly the dominant moving force in crypto right now, and their efforts have enabled many people to enter the space, but their customer service and support continues to aggravate us to the point of suggesting to our subscribers to pretty much steer clear of them. In other news regarding crypto exchanges this week, Japan has expanded their oversight of cryptocurrency exchanges, likely in response to February's $530 million breach of a Japanese exchange, CoinCheck. All exchanges were ordered to improve security efforts and make efforts to prevent money laundering. We see this as a continuing trend of governmental oversight and intervention of exchanges that operate outside the bounds of local law, and will continue to be a trend in 2018 as governments look to stop black market operations within their borders. One exchange that continues to give us hope that exchanges can be better is Binance. After a database issue in February caused a temporary lock of withdrawals, users were wary of Binance, but they handled it well enough that people were seemingly willing to trust them again. That was once again challenged this week as users had their funds stolen from their accounts through a backdoor API breach. The irregular trades were isolated and the culprit seems to have been a coordinated phishing attack. Despite this, Binance has refunded the users who lost their funds and will continue to work to minimize the chance of it happening again. So regulation was definitely still at the forefront of everyone's minds this week, as the US-based SEC decided that anyone who sells tokens is doing so as an unregistered money transfer business, and anyone using an ICO, public crowd sale, is a money transmitter and subject to the Bank Secrecy Act. Furthermore, according to the US-based FinCEN, cryptocurrency exchanges qualify as money services businesses. What this all means is that anyone failing to register their ICO in the US and failing to comply with anti-money laundering and know your customer compliance obligations could face prison under a felony conviction. It's true these moves and words like regulation, government oversight, subpoenas, and big banks trigger paranoia in the crypto market because there's a fear that the legacy system will seek to destroy what the crypto community has worked so hard to create. In addition, recently we've discussed the several banks that have come out saying that crypto is a threat to their business model and bottom line. Despite that, we don't believe that big banks and government entities want to squash crypto. The SEC's recent moves are not an attempt to rid the world of distributed ledger technology and crypto investment. Rather, it's an attempt to curtail the fringe elements and allow true big investors to enter. As it stands, crypto just isn't an investment most traditional investors are willing to consider. The bubble of cryptocurrency isn't likely to burst without those investors playing a role to stabilize the values. We see the US is starting to take a role in setting the standard of what will and won't be accepted in the future. But the amorphous nature of this space and the asset itself is proving to be a challenge for a potential government action and future regulation. While it's true that multiple government organizations have different definitions of cryptocurrency, defining it as a security, as money, as property can all be legally true at the same time. For example, a bond is a security, property, and money all at the same time. Once the multiple government organizations looking into this are able to decide how best to move forward, and traditional investors are able to participate, money will be injected into the market. We feel strongly that the aggregation of reasonable regulations and traditional investment will herald a new and unprecedented period of bullish progress. As a last note, yes, the market is currently hurting, and yes, we're suffering through it right beside you. As we mentioned in our bear market survival webinar, we anticipate there needs to be a second bottom before we can think about retesting our previous highs. We could easily see this week as a continuation of the short-term downtrend that's clearly been established. Yesterday's positive divergences certainly led to a short-lived oversold bounce, but with such major resistance levels keeping us down, it may be several days to weeks before we can come back up for air. With that, I'll turn it over to Doc for what he's seeing. Have a great weekend, everyone.
Hey folks, it's Doc with ReadySetCrypto with your weekend report. Once more, I'm not going to really waste any time here going through the crypto top 10 because we're pretty much all running in unison to the downside here. So once again, this is kind of what I've been talking about here for quite some time. I took a lot of heat back here in February when I was looking for a capitulation and we weren't really getting it. And people said, dude, would you just lighten up? Maybe we don't need to have this capitulation. Maybe the market will release from here. And I was almost convinced of that when we broke this descending pattern here and started to set up a higher high and a higher low. That was looking good so far. But I did caution you guys and said, make sure that this thing makes a higher high above here. Make sure that this breaks out to a higher high above here. Otherwise, this is going to create maximum disappointment with a lower high, and this is almost precisely what's happened. So what we're seeing just in the last couple of days here, since we've done our last report, is the price has now put in a lower high and a lower low. So we've actually transitioned to the downside again. Imagine that. So this is a lower high. Now we have a lower low. Okay, so probing below here. And now we're going to have to watch for that 61.8 retracement. If we see the 61.8 retracement broken through to the downside, that was tested yesterday. But if we see this broken to the downside, then we should expect to see a full retest of about the 6,000 level, if not perhaps a slight undercut of that. Now, on the good side, we are seeing more volume coming here. If this selling was occurring with no volume at all, so in other words, if it was just a drift, or if it was just people basically stepping back from the bids and just saying, I'm not going to take the other side of this trade. I'm not going to argue about price. I'm just going to let this thing go into free fall. That would not be good. We want to see argument and price here, and that's good. So we will typically see, as you see here on all the significant bottoms, we will see significant volume at the significant bottoms. Even though this wasn't a significant bottom, there's the big volume here for the most significant bottom of recent. That just simply stalled us out for a while. This is what we call a larger time frame lower high. You can see that if we go out to the weekly chart and kind of step back and look at this from a different perspective. Okay, see the parabolic move up here. So now when you see the next parabolic move like this, you're not going to chase after this, are you? You've learned a lot from this whole experience that you see something like this and you don't want to take that. In fact, you want to look to take the other side, which is frankly quite difficult right now until we get a better set of derivatives for the crypto market. So what we've seen from this guy is we've seen that, again, the parabolic move up, and then we've started to see it make lower highs, lower lows, lower highs, lower lows, lower highs, and who knows where this is going to finish out here. But the more volume, the more disagreement, and the more negative articles that we see. So some of the negative articles that I've seen is Bitcoin heading to $100. That's almost precisely what you need to see. You need to see maximum negativity. And do I want to see this? No, honestly, no, I don't want to see this. I don't wish pain upon anybody. Right? And this is where people tend to take this very, very personally when they see negative articles, they see negative price action, they see all their friends making fun of them because they invested in Bitcoin back in December. right? So all of these things start to pile up, and it starts to get really, really depressing. It starts to get very, very difficult to hold on to these positions. So all the way up here, you're like, yeah, dude, hodl, hodl, I'm a hodler. Yeah, hold on for dear life. Yeah. And then all of a sudden, now when you're seeing your position carved to about 1/4 of what it was once worth, you're like, well, hodl? And you're not quite as committed anymore. And now you're wondering whether you should just like bail on this thing and perceive or preserve some type of value from it. Been there, done that, got the t-shirt. This is exactly how bear markets work, is that you've got to convince every single person that bought in at the highs to just give it up. And this is always what happens. We see this, it's called the principle of maximum adversity. The market will press you and press you and press you until finally you yell uncle. In a more technical term, that's called capitulation. We really have not seen the capitulation yet. And what I said before is true, that when you see it, you'll know it, because what you'll find is that nobody will want to touch crypto with a 10-foot pole. It gets that bad. Now, the reason why I paint this picture in such dark terms is because of the fact that when the market does rally, when it goes in the disbelief phase, nobody, and I emphasize nobody, will be on board for that rally. Yes, some of the smart money, we will be on board for that. We will be the smart money on board for that rally. But collectively, nobody will be on board for the disbelief. So the markets go from euphoria to disgust to maximum disgust, and then they go to disbelief, where the price rallies and everybody says, oh, come on, that can't be real. That's not actually happening. This must be manipulation. This must be just fake. Look, insert whatever noun that you want to, or subjective body in there that you want to paint as pushing the market around. The disbelief phase always does occur, and nobody gives it any respect until all of a sudden it starts to really move. And then all of a sudden people say, oops, I did it again. And the disbelief will go into acceptance, and then eventually the next euphoria phase. First of all, let's handle this phase down here. Let's handle this disgust. Let's look at it for what it is without the emotions to it, and let's be prepared for that disbelief phase. We don't have to get it all at once. We don't have to get the very bottom. All we need to do is test and nibble, and then add to the position as it goes in our favor. That's all we have to do. It sounds simple to do. It's extremely difficult to actually execute on that plan. I want to talk to you guys for a few minutes about swing trading again. So swing trading is something that those of you can do while you're sitting there twiddling your thumbs waiting for the market to finally restore its former glory. So maybe what you can do in the meantime is play inside of the swing. So what you would want to do at this point is, I would say, pick an instrument. So whether it's Bitcoin or Ethereum or Ripple or Litecoin or whatever your favorite is, take a look at the costs of trading it, of course, right? So sometimes that can make a difference. See what the costs are for trading that instrument. And then start to identify the patterns that the price makes and see if you can catch an edge along there. Now, keep in mind that when the price is rising, it's going to be more linear. You're going to see more structured price action. And being the fact that we're sort of forced to trade from the long side, because right now, quite honestly, I don't believe people should be trading from the short side until we have decent derivatives like options and liquid futures contracts. Right now, the futures contracts are just not any good from the CME and the CBOE, or just don't even think about trading them. They're really institutional instruments right now. So until we get that, we have to trade from the long side. Your odds will improve if you can trade to the long side when the market's rising. So in other words, think about it this way. If the stream of the river is going this way, it's easier to paddle downstream, isn't it? It certainly is. Okay, so in this case, you look to take descending patterns that are breaking to the upside again, or you can use triggers such as going below the Bollinger Band, those kind of things. So when we do have a market that's trying to trend to the upside again, however short that time period is, it's going to be much, much easier for you to find opportunities. Now, this is kind of the paradox here, is that we have this market trending to the downside right now in a smaller time frame, like the 30-minute chart. Now, one thing I said about markets that trend to the upside is they're more linear, they're more patterned, they're more structured. That is true. When they start to trend to the downside, the converse is true. They have much less structure. There's much less symmetry involved with a pattern. You can see that this is more, there's a lot less structure to the price action, to the downside. Corrective price action is just less linear. So I'm telling you guys, as the price trends to the downside right now, you're going counter trend if you want to trade in this. It can be done. It's a little bit more difficult. Now, this is one thing that Mav and I are doing. We're both working on the sideline with Profit Trailer, which is a robot trader. So we're trying to get our hands around this animal. It is not for the faint of heart. It is, if you're not very, very good with technology, it's going to be very intimidating. It's going to be very difficult for you to get going with this, quite honestly. So what you might want to do is instead become a discretionary trader, look for opportunities within the chart. So there's a few things you could do here. You could look for opportunities like as the price closes below, like in this case, I'm looking at maybe a 30-minute chart. As the price closes below the Bollinger Band, that's showing, especially with the volume here, this is showing that it's gone too far, too fast, and you might look for a pop to the upside and maybe target the opposite Bollinger Band price. So these little moves down here where you see it close below the bands and then it reverses, target the opposite side of this. These are not going to make you a ton of money, right? So the big money trades are the ones where you can ride these things for a long way. These are just little scalps that you're playing inside of here. And the way that I like to trade these is, again, with fixed risk positions. It's very difficult to say those three words in a hurry. Fixed risk positions, in that you're only going to dedicate maybe just, let's say, for instance, 20 bucks to that trade, or whatever your currency is, right? So just a small amount of money that you don't care. This is risk capital. And you're going to look for a gain on that. Now, if it doesn't go anywhere, if it keeps on going, say, like for instance, you enter here and then it just keeps on rolling down, perhaps what you can use is a form of dollar cost averaging. You can double up on the position and then look for an overall return from the position where you should be able to score an overall return on the entire. Now, don't martingale too far down there. I would only do it once, especially if you're fairly new to this. In summary here, there's a lot of things that you can do if you want to slug it out and look for shorter term trades. So this is obviously the complete opposite of buy and hold. Buy and hold means that you buy something and you stick your head in the sand and you don't look. You don't try to manage it. You just hold through everything. And you look up and a couple of years later, it should be higher in price, right? So you're not going to have the same, you're not going to have a stop, you're not going to manage the thing. Don't change your mind in the middle of it. Don't be 3 months ago saying, hey, I'm a hodler. And all of a sudden now you're like, what's my stop? Well, you said originally that you had no stop, and all of a sudden you've gotten scared, you've had a change of heart. Don't do that. So make up your mind at the very beginning what you're going to do with a position. It better be risk capital. If it's not risk capital, then you will make an emotional decision and you will make it at the precise wrong time, precise wrong moment. Finishing up today's report for this weekend, as a customer wrote in with a question here, and I thought this was particularly good. I like the way that they attached a nice little screenshot here. And they have a question here about the Bitcoin trend line. So there's two different trend lines. I've seen analysts draw it two ways, red and yellow. So yellow, notice that the yellow version is touching all of the recent tops of the wicks all the way down along here. And this is the one that I recently drew on Bitcoin. But guess what? Technical analysis and charting can be subjective from time to time, especially when it comes to drawing things like trend lines. Now, what you can do is you can take the opposite way of doing this and say, well, what's more important here? So we've got the same one right there. This one, we're going for the close. So the close instead of the tops of the wicks there on those candles. In fact, let me start from scratch here so that we don't have competing. So this one is right at the top of the close there. This one's at the very top. And now what we do is we also have one at the very top here. So currently the red one would explain the drop according to the customer that wrote in with this question. Okay, so let me weigh in this for a second. Trend lines. Is there a proper way and a wrong way to draw trend lines? The answer is no. There is no right or wrong way of drawing trend lines. It is going to be a very subjective combination of art and science when it comes to this. Typically what I will do is I will lean towards using the entire candlestick of this, the entire price range. Just because something is a closing value, does it give it more weight? Perhaps. Sometimes it does. Sometimes it will give it more weight. But what I'm looking for is the maximum number of touches. Where do we have the greatest number of touches? Where does the price actually react to this? So the price reacted several times according to this one. I'm sticking with the yellow one right now. I'm not saying that the red one doesn't also merit evaluation for this, but one thing you have to understand is that nothing will explain the drop. Price is not going to drop just because some random trend line is sitting out there and is an impervious barrier that the price cannot go past. Remember that a trend line is just a trend line. It's just a place where you can connect the dots. And in fact, if I look at this from an intraday basis, I can come up with different trend lines along here. So the fact that there's one on the daily chart, okay, there's probably more people seeing that one. But what happens, what makes price sell off is not necessarily a trend line, but it is supply and demand. Very often you will see, after we have an established trend line, you will see the price come up to the trend line and then use that as an excuse to sell down somewhat. Now the reason for that is because, especially off this yellow trend line, is because Bitcoin came from 6,000 all the way up to near 12,000. That was a big, big move. I mean, it just about doubled at that point, almost doubled. And when you see a trend line like this, again, my expression is, in the sea of sand, one single flag that sticks up becomes a target. So this became a target, not the red line, but the yellow one did become a target because everybody could see that. Not because there's some line that says you cannot cross, right? You cannot cross. It's not like that. It just becomes an obvious target for people to take profits or perhaps sell, take the other side of the trade, whatever. So I know that because I'm posting this tonight, I guarantee there will be people that write in and quote me chapter and verse and say, "Thou shalt abide by the rules of trend lines." And here they are, the rules of trend lines. Guess what, guys? There are no rules when it comes to trend lines. All I'm looking to do is find the trend line that connects the greatest number of touches to the price. If I go here and do the same thing on the 30-minute chart, we can do the same thing here, and my eye is just going to be drawn towards all of these recent highs. You can see how the price does react to that. Now, obviously, this is the first one, so there's no reaction to that. But here's the second one. Now we have a trend line. Now we have the price reacting to this, and then as it breaks through here with a higher low and a higher high, boom, now we have price movement in the opposite direction. That's what we're looking for. So you'll see the same things to the upside, to the downside. I can connect the dots here and say, okay, we've got another trend line as the price goes through this one here. Now, notice what I did here. I kind of ignored the wicks down at the bottom, and I went more off of the bodies of the candles because this is where I get the maximum number of touches. That is always going to be the case. Wherever you see the price react and you can get the maximum number of touches, that is the proper place to put that trend line. Okay, guys, thanks for listening. Have a great weekend. We'll see you back here on Monday. Take care.